I don't normally talk about stocks that I buy or sell here on the YouTube channel, but I did mention that I would open a position in Realty Income if it ever gets to a 6% dividend yield, and it did get to 6%, around $51 per share, and then I opened the position, dollar cost average down, and I still own Realty Income. I made a few videos on the stock. It's finally starting to move. It's around $54 per share. It's no longer a 6% dividend yielder. It's around 5.6 or 5.7%. It's starting to play out. And I did a lot of videos on the stock, but many of you told me that I just keep making bullish videos on the company, but there's a lot of risks involved with such investment. And there's a lot of other bullish videos on YouTube also. Pretty much all videos are pro Realty Income because they tend to get a lot of views, but I haven't done it because it gets a lot of views. I've done it because I have a thesis in general about REITs that they are undervalued, and Realty Income is not the only REIT I own. I own apartment REITs and a few other things. So in this video, I'm going to talk about the bearish case for Realty Income, that if you're buying it, you're likely familiar with the bullish thesis. There's enough bullish videos out there. Maybe you want to hear the bearish case or the risks involved with such investments. And this is something important to look at if you are a shareholder, if you're thinking about buying Realty Income, because there's risks with every single stock. And I'm going to give you 3 main risks with Realty Income here in the video. Now, the first risk, which I have talked about before, is mainly the tenant risk, but this is an extremely long-term risk in my opinion, because Realty Income is getting more and more exposed to tenants that I personally don't like. Like Walgreens is around 4%, Dollar General is 4%, Dollar Tree and Family Dollar 3.3%. This is in total something like 10% of the portfolio is in Walgreens and dollar stores, and 1.4% in CVS. Now, if you're someone that's young and you're holding Realty Income for like 10 or 20 years, I would bet that there's going to be fewer Walgreens stores over the next 10 to 20 years. I would bet that there will be fewer Dollar General or something like CVS stores over the next 10 to 20 years. These kind of companies have been closing stores for years. They're going to continue to, as more things are moving online, especially with prescriptions, with Walgreens and CVS. Now, some of them are doing pretty smart things. They're opening up clinics with CVS and Walgreens. So this is pretty beneficial in general. And I'm sure Realty Income can rent out these buildings if they vacate them to other kind of tenants. So it's not such a big problem. But I would personally love to see more diversification in something like Walmart and Sam's Club. Something like ADC Realty has like 7 or 8% of the portfolio in Walmart alone. This is pretty amazing. And they have Kroger and a few other places. So I would love Realty Income to get more exposure to different areas, pretty much away from Walgreens, Dollar General, and Dollar Tree, Family Dollar kind of stores. I don't believe these stores are going to be up forever, especially with inflation. I'm not saying they're going to all close within the next 5 years, but if you're someone that's an extremely long or very long-term investor with something like Realty Income, like 10, 20, or 30 years, I would worry about such tenant exposure over the very long term. And I would love to see them making more acquisitions like they made with, something like the Bellagio, and they did Boston Harbor for wind resorts. So they're expanding in more longer term leases. But the latest acquisitions had a lot of Walgreens, Dollar Generals, Family Dollars in them. So I wasn't a big fan of it. I wish they get more and more exposure outside of these tenants. But these give the highest cap rates in the market. So maybe this is why, Realty Income is investing in them. But one of the risks I see is the tenant risk, and I hope they move away from Walgreens and Dollar General, maybe into other areas like with wind resorts and something like Walmart, BJ's Wholesale Club, LA Fitness. Such things are pretty amazing long-term holds that I would be very happy with. Now, the second thing that a lot of people are pointing out, and I kind of agree on this, and this is mainly the size of Realty Income. Now, normally, whenever you have size, it comes with advantages because you can structure deals that smaller REITs cannot get into or cannot structure. Something like the deal that I loved about the Bellagio, where Realty Income invested $950 million to get a stake in the Bellagio at something like 5.7 or 5.8% cap rate, which I believed was a pretty good cap rate for a trophy property like the Bellagio. The Dollar General crazy stores in some area in Texas, they yield like 6% cap rate. And you got a piece of the Bellagio at 5.8%. That has been pretty amazing for me. So I loved this deal. But it's over $950 million. And then it did another acquisitions recently, $9.3 billion of Spirit Realty in data centers. And I believe they have no experience or no exposure in data centers. Now, the downside of being such a big REIT or big market cap for Realty Income is you need a pretty big acquisitions to move the needle. Acquiring a few stores here and there or a small competition or 50 million, 100 million does not move the needle for Realty Income. You want to have constantly bigger and bigger and bigger deals. And these deals are hard to find, but they are also more expensive. You typically have better prices and you get a better deal with smaller kind of acquisitions. But once the acquisitions start getting bigger and bigger, you likely have to pay a premium. Like they kind of paid a premium for something like Spirit Realty. In my opinion, the market did not like it. This is why Realty Income initially fell to around $45 or $46 per share. So the market didn't like it. But this is the big problem with Realty Income. That it's going to be harder and harder to grow because of the size of the company. The acquisition are going to be much, much larger. They might not get the best deal. They might not, be the cheapest or the most efficient acquisitions. I mean, I have been impressed so far, especially with the Bellagio. But the latest acquisition of Spirit Realty really shows you the downside of having, a scale of being very, very large. Is that, it's be very harder to grow. Something like ADC or other smaller kind of $1, $2, $3, $4 billion kind of REITs, they can make smaller acquisitions, $200-300 million, grow, get better deals on them, better structuring, less competition, or maybe a little bit more competition with smaller deals. But this is a big difference. And one of the risks with Realty Income is the size, that because the size is so large, they constantly have to look for bigger and bigger deals, which are first very hard to find, and they will likely not get the best deal on them. This is the second risk for Realty Income. The third one is the debt. This is within the big bearish case, and I talked about this one before. They do have a lot of maturities maturing in 2026. I don't believe Realty Income is going to be able to pay it off with the free cash flow. It's almost impossible. So they will likely either have to refinance it or issue some shares and then pay this debt. Now, we might have much lower interest rates by 2026, so that would be good if they can refinance it, push up to the future. This is not the first time Realty Income experiences this. But again, the balance sheet could be one of the risks with Realty Income in the bearish case. I think they will potentially manage it and then, bring it down to lower levels and make it better again. But this is the third risk with something like Realty Income. The most important one, I personally believe, is, the scale of the company, because it's going to be harder and harder to find these acquisitions. But if we look at the valuation of Realty Income, because this is a big piece that most investors miss. They all look at all these risks and they say, Realty Income is not worth it. Well, how much are you paying for these risks? How much are you paying for this exposure? This is the question you should be asking yourself. Well, with Realty Income, the dividend is still one of the highest over the last 10 years. It's around 5.8%. It's no longer 6.1 or 6.2%. You could look at the price to AFFO per share. It's still sitting at 13 times AFFO per share. This is lower than the March 2020 lows, as low as it traded at in the 2008 to the 2009 financial crisis. That would give me that there's a lot of bad sentiment with the stock. Yes, interest rates are much higher and it deserves a lower multiple. But if you believe the interest rates are not going to be 5% forever, and even Powell himself said the neutral rate is 2.5%. So it's 50% less from here. There could be over 50% upside on Realty Income if the multiple readjusts to the mean. I'm not saying it's going to go back to 24 times 0% interest rate. I'm saying the mean is 17.5. Now it's sitting at 13. So if it just goes back to 17.5, this is a massive, massive return. But even without a multiple expansion, Realty Income itself is calculating for you their potential return. And I do agree with their graph here. I mean, because I calculate the return the same thing. You get 4 to 5% dividend. Now it's pretty close to 6% dividend. You get something like 4% AFFO per share growth from the acquisitions. This is around a 10% return every single year, excluding a multiple expansion. Now, if the multiple gets to the mean, I talked about it many times, this is over 15% every single year, which is a double every 5 years with a high quality REIT like Realty Income. This is pretty much unheard of. Normally, REITs deliver single digit return, but I've been saying for a long time, or for a while actually, for pretty recently, that for the first time in a long time, I'm seeing double digit returns with REITs. And I'm still seeing 15% return annual with Realty Income, even though the stock has started to recover and the sentiment looks like to be changing. I personally believe Realty Income has bottomed. I could be wrong, but I believe rates have peaked. Therefore, Realty Income should have bottomed, especially with such sentiment. So this was my opinion on the bearish case of Realty Income. There's a lot of risks, but there's a lot of reward because there's a lot of it is priced in within the valuation. But this was my opinion on it. You know, it was not financial advice. Thank you for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.